Hello everyone, I will cover Chapter 6 in this lecture. This chapter is about common stocks, and these are some of the concepts that we will cover. So we start with common stock ownership. Common stock ownership means the investor becomes a shareholder or part owner of the firm. The stockholders are known as residual owners. That is because their claim is secondary to other providers of capital. Mainly, the lenders have the first access to the company's assets in case the company is in trouble. Only after repaying the lenders, whatever is remaining is distributed among the stockholders. So that is why they are known as residual owners. So why is common stock in demand? Because stocks provide an opportunity to earn returns, both in terms of capital gains as well as in terms of periodic income through dividends. So how do stock prices behave? So when the market is strong, the investors can expect the stock price to increase. When the markets are declining, the investors can expect the share price to go down and the returns to decline. However, we notice that stocks have on average generated positive returns. So if we consider the 92-year period and look at the annual return for the S&P 500 index, we find that only in 24 instances the annual return is negative. For other instances, it has been positive. So this shows that stock on average provides positive return. So these are the total return during different decades. Total return means return from dividends as well as return from capital gains. And we notice that it is generally positive in different periods of time. Another important aspect that we must note is the correlation between the real estate sector and the stock market. So whenever the real estate sector or the housing sector does well, the price of real estate goes up and the US stock prices also goes up. And when the real estate sector, the housing sector declines, the stock prices also go down. So if in particular, if we look at the 2008 financial crisis, the housing sector suffered serious losses, and that also led to serious decline in the stock market. So if you notice, there is a positive correlation between the performance of stock index as well as the housing index or the home price index. So what are some of the advantages of stock ownership? Stock ownership provides substantial returns, much higher returns on average compared to other asset classes such as bonds. The returns are generally in excess of inflation, right? So stocks provide protection against inflation. These stocks are easy to trade in terms of buying and selling on the stock market, and the information about stock prices and about the stock market is easily available, which helps investors to take suitable decisions. What are some of the disadvantages of stock ownership? Stocks are subject to different risks, similar to the risk faced by the company which issues the stock. So the stock prices may also decline along with the business of the company. Stock returns are highly volatile. While they are on average higher than other asset classes, they also fluctuate more than other asset classes such as bonds. And stocks also generate less income on a regular basis as compared to bonds. So if you look at this graph, the red line is for the the interest income from corporate bonds, whereas the blue line is the dividend income from stocks. So we see that stocks on average provide less income on a regular basis. So now we look at some of the characteristics of the common stock. Common stock is also known as equity because it provides ownership of the company. So the common stock can be publicly traded. So these are stocks which are listed on the capital market and they are bought and sold by public investors. Common stock can also be new shares listed on the stock market. So one is public offering, where the company is offering new shares to the public investors, and it can also be rights offering. So here the company is offering new shares to the existing shareholders on a pro rata basis. So in either case, what we see is that the company is increasing the equity in its capital structure and the number of outstanding share also increases, either through public offering or through rights offering. So this is an example of an announcement for new stock issue. It could be public offering or could be rights offering. Another way to uh, access common stock is stock spin-off. So in this case, a company will spin off a subsidiary or a business division as a separate company. The stocks of this newly formed company is made available to the existing shareholders of the company. Companies generally go for spin-off when they decide that a certain business division is no longer relevant for their business operations. It's better for that business to operate independently. In that case, they go for spin-off, and it provides opportunity for shareholders of the parent company to access stock of the spin-off. Common stock can also be made available through stock split. So in this case, the company increases the number of shares outstanding through exchange of shares with the outstanding share. So 2-for-1 stock split means two new shares are available in exchange of existing one share. So companies do this to make the stock price more attractive to investors. As the outstanding shares increase, the share price tends to go down and it becomes easier for investors to buy or sell the stock. Treasury stock is a special type of stock. So these are stocks held by the company and they were repurchased from investors through buyback programs. They were originally offered to public investors and later they were repurchased through buyback program. So through this buyback program, the company is able to reduce the number of outstanding shares, and the repurchased share can be used to pay stock dividends or can be used to provide employees with stock option. Companies also go for buyback when they believe that the real value of their stock is more than the price at which they are trading. So they are buying their own stock at a discount and expect to earn profits in future. Repurchasing share also is a way of giving income to the shareholders instead of paying dividends. Another variant is the classified common stock. So in this case, the common stock has different classes. Each class signifies different voting rights. So the example of Facebook. Facebook has two classes of share. So class A share is available to public and it allows one vote per share. Whereas Class B shares are available to the top management and other company insiders. So in this case, the shareholders are able to exercise 10 votes per share. The idea of having different classes of share is to give more voting rights to a certain group of shareholders, mostly company insiders and top management. So now we look at the process of buying and selling stocks. So to buy or sell stocks, we look at the price of the stock. This is available from the financial price. And based on the stock price, we can calculate the market capitalization. Market capitalization is the total number of outstanding shares multiplied by the share price. This is a typical example of share price information, which may be relevant for investors for buying and selling transactions. So what are some of the transaction costs involved in buying and selling? So investors can trade in round or odd lots. Round lot is in multiples of 100. Odd lot means less than 100 shares of stock. So this is common way to place orders. And once the order is placed, the investor will have some transaction cost. One part is the brokerage fee that is paid while doing the trade. Apart from that, there could also be a bid-ask spread. So in this case, bid is the price at which the investor will sell the stock, and ask is the price at which the investor will buy the stock. So the difference between bid and ask price is a cost which is incurred for round trip trade, that is purchase and sale of the same stock. So see, these are some of the costs involved in trading of stocks. So we look at some of the value associated with common stock. The first is the par value. This is an accounting term, and it is actually an arbitrary price assigned to the stock when it is first issued. Book value is also an important accounting term because it represents the stockholders' equity. So it is the company's asset minus liabilities divided by the outstanding shares. So that gives the book value of each share. It is backward looking because it is based on accounting information, and accounting information is historical nature. So it is for maybe it is for a period of 1 year or a quarter which has already passed. Market value is the current price at which the stock is available in the market. So it is forward looking because it represents the investors' expectation of how the company will perform in future. And we notice that market price is generally higher than the book value. However, if the market price goes below the book value, then it is a signal of financial concern or financial distress for the company. The next value that we can consider is the investment value. Investment value means it's a notional value which an investor expects of any stock. So this is based on the risk return trade-off for individual investors, and that helps us to understand what is the expected stock price for an individual investor. That is the investment value pertaining to that particular investor. Now we look at different concepts related to dividends. Dividends, as we know, is a source of return which provides income to the shareholders at regular basis. So dividend income is also taxed at the same rate as capital gains. So we have looked at the capital gains tax rate in a previous chapter. So dividend payout is a corporate decision. In this case, the board of director may look at the company's performance, the company's financial position, and accordingly decide whether and how much dividend should be paid to the investors. So we start with the concept of earnings per share. So that is the net profit minus preferred dividends divided by the total number of outstanding shares. So that gives us an idea of the earnings per share. Now, the company's top management and the board of directors have to decide. So what are the growth prospects for the company? If there is significant growth prospect, then some of the earnings have to be reinvested in the company so that the company can grow more. Then it would not be possible to pay dividends. There might be some loan conditions which says that the company cannot pay out dividends or the company can pay out dividends only to a certain limit. This is to ensure that the company pays interest to the lenders first and then focuses on dividend payout to shareholders. So these are some of the considerations at the company level. Then there could also be market level factors. Whether the company can explain that it can generate higher returns by reinvesting the earnings in the business. Whether there is an expectation among shareholders that the dividend will be provided. In that case, the company may have to seriously consider dividend payouts. So there are both internal as well as external considerations in deciding whether to pay out dividends. So what are some of the important dates with respect to the dividend payout? The first is the date of record. So this is the date on which the investor must be a registered shareholder in order to receive dividend. Then we have the payment date. This is the date on which the dividend is actually paid to the eligible shareholders. And then we have an ex-dividend date. This means the date before which the shareholder must be, the investor must be an eligible shareholder. Otherwise, they will not receive the dividend. For example, if I become a shareholder of a company after the ex-dividend date, then I will not be eligible to receive the dividends. The seller from whom I bought the shares will be eligible for receiving the dividends. So ex-dividend date is like a cutoff, after which even if I become the shareholder, I will not receive the dividends. The declaration date on which the company decides to pay dividend, announces that they will pay dividends. Ex-dividend date, the date after which if I buy the shares, I will not be eligible to receive dividends. Date of record, the date till which I am considered eligible to receive dividends if I am a shareholder and final the payment date. So what are different types of dividends? One is cash dividend, is the most common form. Cash payout to shareholders. And then we have stock dividend. In this case, the investors receive additional stock instead of direct cash. Sometimes dividends can also be in the form of stock of spin-off companies or samples of company products. Either cash or kind. That is how the payout is done. The most common way is cash dividend. So for cash dividend, we look at the concept of dividend yield. Dividend yield is the annual dividend per share divided by the current market price. And dividend payout ratio is the percentage of earnings which is paid in dividends. That is dividends per share divided by earnings per share. The other type is stock dividends. Stock dividends, the company will provide additional stock to the shareholder instead of direct cash. If it is a stock dividend, then the investor does not have to pay taxes until they sell the dividend stock. Another aspect of this dividend payout is the dividend reinvestment plan. So in this case, whenever shareholders receive cash dividends, they automatically reinvest that money in the company by buying additional shares of the company. So this is a convenient way to invest the cash received from the company. Here, there is a tax liability because the assumption is the uh, shareholder has received cash in their hands, which will be taxable. They have invested the cash in future in the company. So the reinvested dividends is treated as taxable income because it is based on cash received in the hands of shareholders. So that is all for chapter 6 for the time being. So I'll continue with the rest of the chapter in the next lecture. Thank you.